In this section, we'll be turning our attention away from stocks in the market and we'll be focusing on managing our resources best. The three key elements here will be position sizing, risk management, and portfolio management. If you want to maximize your return and limit your risk, this topic is absolutely essential. You cannot obtain optimal results or survive turbulent markets without a strong foundation in this section. The first topic we're going to discuss is position sizing. I believe there are two big problems when it comes to position sizing: having too much exposure on a loser, and equally as important, having not enough exposure on a winner. I like to think of position sizing as similar to how you would determine what speed you want to drive at in a race. If you go too slow, you'll lose the race, but if you go too fast, you'll crash. If you get this part of your approach wrong, it will ultimately undermine all of your other efforts, so it's absolutely critical. There's a constant trade-off between maximizing returns and managing your risk of ruin, as well as having an impactful size on your account and limiting single stock risk. As well, if you let your emotions guide you, you will likely be too aggressive after a string of successful trades or too timid after a losing streak. For these reasons, I believe position sizing should be mechanical. Each position should be a fixed percent, and this will prevent you from being light on winners and heavy on losers. Now, a common question that will come up is how concentrated a person should be in one stock. Maximizing returns ties directly to drawdown, and the lower your win percentage and the longer your possible losing streaks, all the more important it is that you reduce your position size. Otherwise, your drawdowns will be too deep and your eventual winners will not be enough to help you. Never forget the asymmetry of losses that we discussed earlier in the course. This is really a crucial pillar of knowledge to be successful in the market. I would consider a position size of 25% of your account equity as aggressive, and I would view a position size of about 10% of your account equity as conservative. And it's really up to you if you want to be somewhere in between those two numbers. After many years of experience, I prefer increased concentration within my portfolio, but that really requires confidence and experience with your approach to active investing. Some of the benefits to increased concentration include the ability to quickly identify which stocks are behaving strongly or weakly, and as a result, which stocks are the market leaders of your portfolio. In addition, it allows for your big winners to have an impactful size on your overall returns of your portfolio. However, along with all of the benefits of increased concentration come several drawbacks, primarily being increased levels of volatility in your returns. So whatever size and accompanying volatility you think you can handle, go smaller and reassess after several months. In addition, increased volatility requires mental toughness to control all of the harmful emotions that arise, and you can only develop that with experience. So really take your time and become accustomed to applying the strategy before you increase your concentration. When it comes to concentration and portfolio management, I believe that the way to achieve the best of all worlds is through position building. When you apply position sizing in tandem with position building, it allows for increased concentration levels as trends develop, but has you position smaller if they don't. It is essential to keep in mind that I view my starting capital and my unrealized profits differently. I believe that protecting my starting capital is the most important aspect. As a result, I use unrealized gains within my position building to allow for a concentrated position to be built while maintaining reasonable risk exposure to my starting capital. It's a trade-off that I make and one that I accept. Giving back smaller unrealized gains, in my opinion, is worth it to have limited risk to my capital and concentrated positions in my large winners. To present this concept more clearly, let's take another look at Sea Limited along with the Caruso dollar stop that we covered in the selling section. We will look at three identical charts and entry points, and the only element that will really change will be the position size. That will allow you to compare how different concentration levels will affect your overall account. Let's take a look. In the first example of Sea Limited, the main assumption I made that stays true for all three examples is that the account size will be $240,000. The second process that is consistent between the different charts is that a full stock allocation will be built with three different purchases. So in this example here, a full stock allocation will be $84,000 or 35% of your account equity, and each purchase will be 1/3 of that amount or $28,000 or about 11.7% of your account equity. The maximum loss will also change as a result, and in this example here it's $2,100, and that's 7.5% of the initial purchase amount of $28,000. The overall impact to your account on a loss will be 0.875% of account equity. That will also vary with the other examples, but they're all linked to the fact that we're varying our full position size as a percentage of account equity. Now, I know that I mentioned earlier that an aggressive position size is 25%. Here at 35%, we've taken one step further, and I really want to show you the full spectrum from being extremely aggressive to being conservative with a 10% position sizing. To be fairly honest, I usually position my stocks with about a 30% allocation to my account, but again, I'm very experienced especially with this style of investing, and that does take time. So please do start slower and work with what makes you comfortable. So we can see here, we had our first buy point where we had a kicker, which opened at $44, and we initiated with a position size of $28,000 or 1/3 of a full position. Our maximum initial stop was $2,100 or $3.30 a share, which brings our stop to $40.70. Although traditionally with a kicker, as we covered earlier, we can place our stop at the close of the prior day. In this example here, I want to show the maximum amount of space that a stock has to move before being stopped out if you use the dollar stop. So that'll be indicated by the horizontal red line here on the chart. As you can see, we also broke a 3-touch trend line. So it's always very nice when you see these multiple buy signals trigger at the same time. A day later, we climbed and we broke out above a 50-day moving average resistance failure at $46.50, and we initiated a second purchase of another $28,000 or 600 shares. We now have a 2/3 of a full position, which is 1,235 shares, and an average cost of $45.21. Keeping that Caruso dollar stop consistent, we still have a maximum loss of $2,100. However, given that we have more shares now, the stop naturally tightens to only a $1.70 risk versus the prior $3.30 risk when we first bought this stock. However, that still leaves our stop at $43.51, which is 7% distance from where we made our second purchase. So because we are pyramiding into our positions, even though we are tightening our stop, we still have adequate amount of space to allow for normal volatility. And that pullback did come after the purchase, where we can see here we did go slightly below our cost, but we stayed above our new stop loss level. From here, we blasted higher, and we finally formed a mini coil on the right side of the base, just above the prior highs, as the stock consolidated and formed the handle area. And we made our last purchase of $28,000 or 490 shares at $56.90. The position is now 1,725 shares and is a full position, representing about 35% of our account equity. Since we're sitting at about 17% from our average cost, we're no longer going to take a loss on the position, and our maximum loss is $0 and our stop is at $48.54. As you can see from that point, however, we never even came close to our stop and we just moved higher. This shows the added benefits of building a position over time, where you can have that same controlled risk of $2,100 despite increasing the position threefold and forming an entire full position, which represents 35% of your account equity. Despite the 35% of account equity exposure, the loss is consistent at less than 1% and only 0.875% of account equity, which allows you to have a very large position if you're right and reap huge gains and have impactful size, and at the same time have a limited risk that won't hurt your account or cause a very large drawdown if you're wrong. We're not going to spend too much time on the next two charts. You can dive in and study these at your leisure. I just want to point out that what's changed here is that we now have a 25% equity allocation. So that changes our full stock position from the prior $84,000 to the now $60,000 for a full stock allocation, representing 25% of account equity. As a result, our maximum loss on a position is dropped down to $1,500, which is still a 7.5% of the initial purchase amount of $20,000. The added benefit here is that a loss will only have an impact of 0.625% of your account equity rather than the 0.875% with the larger position sizing. The drawback of that is that now you will have a smaller position if the stock is a big winner. However, even with a 25% equity allocation, you're still rather significantly invested if the stock goes your way. For that reason, although most people are not accustomed to having positions this concentrated because they're typically fearful of the risk of a stock moving against them, if you build that up through position building, it still allows you to keep a relatively controlled amount of risk and build up that exposure. This is where the real benefit comes in of using position building with all the other aspects of the strategy. Lastly, we'll look at a position that represents 10% of account equity, and so a full stock allocation drops down to only $24,000, with 1/3 of that position being $8,000. As a result, the maximum loss on the position is $600, and that still represents 7.5% of that initial purchase amount of $8,000. However, and again, we can see here the impact of the total account will only be 0.25%, so absolutely minimal. So it's really up to you to decide where you want to live on this spectrum of risk And that's really a personal decision. The more you increase your position sizing, the more a drawdown will likely occur if you have several losers in a row. However, if you catch some great positions that go your way, you'll be heavily invested and have impactful size when you're right. As you can now see, this is where the active growth investor approach becomes so powerful versus other methods, because position sizing and risk management work cohesively with everything we have developed to date in the course to maximize your gains and limit your risk. To recap, first you want to study fundamentals to identify stocks with significant potential. You then identify a shaper pattern indicating institutions are still accumulating the stock, and fine-tune with entries with tactical patterns that allow for precise risk management. Any other methodology that does not allow positions to be built over time will likely require more significant losses to your capital to maintain equivalent concentration levels, because the entire position is entered into immediately. This is why I believe this approach is far superior to others in terms of risk-adjusted returns. And whenever you put on a large position all at once, I can promise you from experience that that's when these black swan events will show up with equity financings or downgrades or bad news. I can tell you many times it's happened to me that I'd buy a stock at $3.59 just prior to the close, and moments later I find out that bad news hits the wire and the stock is going to be gapping down the next day, and I'll have a lot of exposure on. That's why I've really developed this approach over time to build that position slowly so I can get the best of all worlds and have a strong concentrated position in my winners, but have very small positions if my losers gap against me. Traditionally, people will put their entire position on all at once, and that really does expose you to black swan events or bad news. And I can tell you it happened many times to me that I'd put a big position on just prior to the close, only to find out there's an equity financing or some kind of bad news or analyst downgrade that's going to gap the stock down lower the next morning. And it's really frustrating, and it takes a big hit on your account equity. For that reason, I developed this approach where I could concentrate safely over time thanks to my knowledge of the shaper patterns and all the different tactical buy points, and have that concentrated position when I'm right. But if I initiate a position and it gaps down the next day, I have a very small position. And that's really the best of both worlds in my opinion. There's one small nuance I just want to cover before we move on, and that's where we get to the point of added pyramiding along the life cycle of the stock. So as we get to new basing structures and we put on new positions, I deal with those a little bit differently. So let's just take a quick look at an example to clear it up, so when you're dealing with this in real time, you'll know how I would adjust my stops and adjust the risk of the positions accordingly. In this example here of Chipotle Mexican Grill, we have this beautiful cup with handle that formed in late 2009, early 2010. You can see we had 3 tactical buy points that helped you build your full position, and you had an average cost of $92. Once the stock advances 10% from this basing structure, new purchases are treated independently from the previous average cost that we developed. The reason for that is you want to avoid some improper high-price buys from raising your average cost too much and ruining a great position that you built over time only because you made an improper buy too high. For that reason, if you make a purchase way up here after an extended move in the stock, if that purchase starts to fail, you will just stop out of that one purchase and treat the earlier position as an independent position. Once a new base forms and you build a new position, and that new position breaks out and advances 10% from the second base, at that point I join average costs and treat it as one large position, because I know that there's enough in advance and enough evidence that this basing structure was a correct basing structure that I'm willing to raise my average cost, so that I'm not too worried that I'll be busted out of the entire trade if there's just a small pullback in the stock. Now that we discussed position sizing, let's take a deeper dive into risk management and portfolio management. This whole system is really designed to maximize exposure when you're right while limiting exposure when you're wrong. And I really believe that risk management is the absolutely most essential part of any investor's toolkit. Without risk management, it's certain you will fail at some point in time, because you will purchase a stock that's going to take a big drop lower, and that's going to absolutely ruin your account equity. But don't take my word for it. Take a look at some quotes from Market Wizards by Jack Schwager, where he interviewed some of the world's best investors. Let's see what they thought about risk management. Paul Tudor Jones says, risk control is the most important thing in trading. Ed Seykota was quoted as saying, there are old traders, there are bold traders, but there are very few old bold traders. Larry Height's quote, which I particularly like, is him saying that risk is a no fooling around game. It does not allow for mistakes. If you do not manage this risk, eventually they will carry you out. And lastly, William O'Neill says that the key is to lose the least amount of money possible when you are wrong. As you can see, all of these market wizards and experienced pros had an extreme focus on risk management. Now, the term risk is used rather generically. However, there are many ways that risk is present in the marketplace. Amateurs really do worse in a bear market. Take a look at this next chart. This is the 2008 crisis, and amateurs who are really unaware of anything we've spoken about to date will typically hold on to a stock and just get killed as stocks plummet lower and lower over time. However, the most damaging market to a semi-professional is a very choppy market environment. And I think 2011 is a great example of a market battlefield. Every time you're entering a stock looking for a new trend, the market will reverse and stop you out with a loss. And if you don't have good risk management tools and portfolio management tools in place, you can absolutely decimate your portfolio. You need to realize that you are really trading your account. You're not trading your chart. You're not trading fundamental analysis. Your account is all that matters. And often in the confusion of the market, we can forget that. The good news is that with the active growth investor approach, the rules will auto-adapt your exposure and your trade frequency. It's hard to be fully invested in a bad market because there's not enough follow-through on your buys for you to build that position. And lack of proper bases and the specific criteria that go behind those bases limits the number of opportunities available to you, and that reduces your churn and your losses. However, the main danger that is still present, even if you have all of these risk controls in place, is that you'll most likely be trading the biggest at the end of a trend. By that I mean, if your positions are a direct percentage of your account value, as your account peaks and starts to decline, all of your losing trades will be the largest trades you have on for the entire advance. And so for that reason, individual stocks and their stops are not enough. We need direct portfolio management rules to control drawdown. Beyond all that we covered, which is rather defined, portfolio management can be treacherous in a trendless market, especially for active investors applying a trend-following system. Therefore, you always want to stay focused and control your equity curve. Remember, the asymmetry of losses is so important. You always have to review that chart and keep in mind that the bigger your losses, the exponentially more difficult it is for you to come back. Also, you need to control your mental capital. We discussed this in mindset, but this is really tied to risk management and portfolio management. Your mental capital is directly tied to your drawdown. You may be a little bit frustrated if you have a 5% drawdown, but once that starts to drop to 15, 20, 30, 40%, you're going to be absolutely frustrated. And that's where even more mistakes are going to take place. And often that's where traders unravel and completely blow out their account. As we mentioned earlier in the course, drawdown is my preferred tool for risk management. It is simple, yet it cuts to the heart of what matters, that asymmetry of losses. If you're not completely clear on what drawdown is, it's simply how far you are off your highs. If your account reached a value of $100,000 and falls to $98,000, you simply have a $2,000 drawdown or a 2% drawdown. Now, trading is complicated, and controlling drawdown is a non-negotiable element. The simplicity of drawdown as a risk measure is what in part makes it so effective. And it's especially crucial for individual investors where absolute returns is what matters most to us. It's not a Sharpe ratio or performance versus a benchmark. Individual investors are concerned with not losing money and making as much money as possible. So this leads us to how risk management and portfolio management can work together. Over time, I've developed rules to force me to react before drawdown becomes too deep. Let's discuss some scenarios, and these rules will all be inside your supporting documentation. I first began to develop rules like this when I was reading Market Wizards, and I realized that Paul Tudor Jones discussed a monthly circuit breaker. So the way he would approach the market is that if in 1 month he had a loss of 10% of his account, he would stop trading for the rest of the month, just to limit himself, control himself, and force himself to get back into focus. Now, this rule as Paul Tudor Jones created it is not as practical with our approach because it takes time for us to build our positions. And as trend followers, you don't want to be sold out of all your best stocks just as a result of a normal market pullback. So I modified it to keep it in the spirit of what we're trying to do. So essentially, once you hit a 10% drawdown, you want to sell all of your non-leaders and you do not want to open any new positions until you're back above your 10% drawdown mark. This allows you to stay in your leaders, yet still react to the fact that your account value is dropping. Now, if your account is 15% off your equity highs due to your leaders correcting, you have to get a little bit more aggressive and make sure you're off of margin. At that point there, if you're sitting in a major leader, you need to keep your eyes out for shaper sell signals and make sure that there isn't a real end of trend happening. If not, you may have to sit through a new base building process, but you want to be off margin so that you're not going to be caught off guard if the market conditions worsen significantly. Beyond the monthly circuit breakers, I like to use one-day circuit breakers. Now, once you become very concentrated and you're using margin, it may often happen that your account falls by 5% or more in 1 day. If your account falls by 5% or more in 1 day, you want to sell all stocks where you don't have at least a 2 or 3% cushion. Perhaps some kind of market catalyst came out, or your stocks are all just too extended, or you're on way too much margin. Either way, you need to react to the fact that your account has fallen 5% in one day. There's been a significant event in your account, and you need to react and reduce all non-core positions. That brings us to the point that you always want to be aware of what your exposure is. Once you start to get on margin, you start to increase your risk of significant drawdown. So whenever you're on margin, always be aware, and if ever you get these very large one-day drops, you need to react immediately before things unravel and you have a very, very large drawdown in your account. Before you go on margin at any time, and especially after a drawdown, I always like to wait to make sure my account advances by about 5% so that I know I have some profit cushion to work with as I'm going on and taking that additional risk. Margin is risky. It's a double-edged sword. It works great in your favor when the trend is working for you, but if it moves against you, the losses happen that much quicker. And typically, things are exacerbated when you have what I call silent overconcentration. Watch your sector, watch your industry concentration. Often leaders will come from a few select sectors or industries that are very strong due to changes in industry dynamics or leading new technologies. However, if there's profit taking in those sectors, and given that leaders tend to have greater volatility in the first place, you may be much more concentrated than you realize. 3 technology stocks representing 70% of your portfolio is actually much more concentrated than what you think you have with only 20 or 25% in each stock. So be very aware of that, because that can really impact your drawdown. Some other scenarios we need to discuss is reacting to market conditions. We'll cover what those conditions are next in the next module. However, I want you to be aware of how you should adjust your portfolio if they occur. So if the market is in a bearish trend, which will be covered next, you really want to be off a margin and aim for a 30% cash position. It's very difficult to say, once the signals are there for a bear trend, that you want to be completely out of the market, because sometimes the market's correct and they look very precarious, only for them to turn around and advance higher and you've sold out of all of your stock. So if you have some great leaders and you want to hold onto those leaders, it's fine. But having that cash position really allows you to weather the volatility that's going to come to your account. Whenever you increase your cash position, by default, you're going to lower that volatility in your account, and it really is going to help you to stay calm and stay focused on your best merchandise. On the flip side, which is not really a risk management tool, but since we're talking about reacting to the market, I want to bring this up. If you're in a bullish trend, or if there's a follow-through day, which we're going to talk about next, you really want to be invested somewhat in the market. So if you have signals of an uptrend taking place, you don't want to be stuck with only a cash position and no stock. You need to change that mindset. And that's something William O'Neill always spoke about in regards to the follow-through day. If you're in cash coming out of a big bear market and a follow-through day occurs, or your upward trend signals occur, you need to be invested with some stock. And I would say you need at least a 35% position. That's typically enough to change your mindset from being very scared and worried and getting ready to start looking for new leaders and buying the best merchandise. These are some simple rules that work for me, and these are all situations that I have come across. And that's why I'm presenting them to you, because I'm pretty sure if you're active in the market, you're going to come across all of these scenarios at some point in the future. I think it's important that you have rules like this and preparation to react to swift moves in your account. You want to have that plan when that market punches you in the face. The aim of these rules is to allow you to avoid your account from unraveling due to many stop losses, or prevent you from freezing up due to conviction of your positions, or just being shell-shocked by an account slide. Now trust me, that can happen. Oftentimes you're sitting there with all of these great positions, everything is looking great, and bang, out of nowhere comes this big market turnaround, and you just can't believe what's happening in front of your eyes. But you have to react. Again, you're not trading a chart, you're not trading fundamental ratios, you're trading your account. So when these different scenarios trigger, you need to move to risk management mode and protect your account from major drawdown. Similar to stop losses, all of these risk management tools will override your conviction. Risk management trumps all. So always stay focused on your risk management and be prepared to deploy them. Think them over, mentally prepare in your mind how you'll react if there's a surprise move in the market. We discussed expectation breakers in the tactical buying section, and that is really what happens often when people get shell-shocked. When there's an expectation breaker on the downside, people are very slow to react and exit their positions, and they do so only after the damage is very significant. So don't be caught off guard, have your rules ready, and be ready to react. Despite everything you do and all of your planning, eventually you're going to hit the dreaded losing streak. Trust me, it's coming for you. Despite all of these tools, a drawdown in excess of 20% means there's something wrong with either the market, your mindset, or your tool application. If you review that asymmetry of losses chart that we spoke about several times already, beyond a 20% drawdown, it becomes exponentially more difficult to come back. So when you start to hit that 20% drawdown level, you absolutely have to put on the brakes. A couple of great quotes by Ray Dalio are, knowing how to deal well with your setbacks is as important as knowing how to move forward. And recognize that mistakes are a natural part of the evolutionary process. So don't beat yourself up if you make a mistake. Just learn from your mistakes and plan and be ready for the future. And here is your plan for when all else fails and you need to regroup. Step 1, be off of margin. I've already spoken about this several times. It is so critical, be off of margin. Step 2, close all positions that aren't long-term leaders. And for those that you do want to keep, take out all of your sell rules and make sure that you haven't missed any of them. Third, keep a minimum of 30% cash until you recover at least 5% of your account. Prove that you are making progress again. That's really the cost of a drawdown. And I've been frustrated by this rule in the past, even though I implemented it. But it's important that you can prove to yourself before you start putting on additional exposure that you've recomposed yourself. Forcing yourself to have that 5% increase in your account value proves that you've recentered yourself. Also, you want to review all of your trades from the start of this losing streak. What are the main drivers of your losses? Take out a sheet and start to look. Is it that you're buying stocks showing weak relative strength? Were you too quick with exposure? Were you not waiting for 5% between buy points on a stock? Did the market trend turn and you're not realizing that you're in a downward trend? Is it as a result of slippage and big volatility and being stopped in and out of stocks? Perhaps you're not adhering to your specific buy rules and you're jumping based on emotion or FOMO? Do you have a failure to follow your plan, your stops, your risk management? Review all the reasons why you bought and sold your stocks. Or is it really just an endless series of bad trades that look good? If that's the case, go back, look at past leaders and review. Are all of the same elements there, the shaper patterns, the fundamentals, and the tactical patterns? Somewhere along the way, you're making a critical mistake that is directly linked to one of these reasons for your losses. How do you stage your comeback? Diversify, but concentrate. By that I mean you want diversification over price and time. So you don't necessarily need to have many stocks. You can have only a handful, but you want to start buying them slowly and build those positions slowly over time and slow yourself down and slow down your exposure. The benefit of having less stocks but holding on to some of these winners is that it's going to lower your churn, your in and out of the market, which often has a lot of volatility and will really hurt your returns. Often less is more. And I really believe that not all stocks go up, but all stocks will go down in a bad market. So for that reason, take a step back, recenter yourself with the original aim of this entire approach, in that you want to buy a stock that's changing how you live, work, or play. There aren't a million of those out there. So stop and really focus on quality. That's going to prevent you from over trading or having so many losses that your account is just cut up by a trendless market. I've noticed that usually lower quality names will ruin the good names in your account. Typically, the lower quality names will break out last in a market trend just as the market is overextended. And those losses will undermine the overall profitability of your account and trigger a lot of sell and risk management rules just about the time the market is done pulling back. So you want to avoid lower quality names and focus on quality. Now, I also want to discuss how to deal with losing streaks apart from market rules. You're going to notice that when you're in a deep drawdown, it's going to significantly affect you. You're going to be stressed, you're going to be frustrated, and you're really going to be off balance. Now, you want to sleep, you want to exercise, and you want to sell to the sleeping point. I don't know how, but my body always knows. I always wake up at 3 or 4 in the morning the night before I take a big market hit. I just know internally that I'm improperly positioned, I'm overexposed, and it always happens that way. And if you can't sleep at night, it really means you're too heavy. You want to sell down to that sleeping point. And just as Jesse Livermore would go to bed at 10 o'clock at night and leave a party if he had to so he'd be ready for the market the next day, you want to sleep, you want to exercise, you have to take care of yourself. As I said early on in the course, investing is really a whole life process if you really want to be the best in the marketplace. You know, no system will work if you aren't comfortable. So if the volatility is just too much for you to handle, reduce your size. The key is to remain emotionally neutral. As Ray Dalio said, the biggest threat to good decision making is harmful emotions. As you can see, this whole course is one big system that works together to achieve your goals, and risk management is job number one. Now that you know how to deal with the losing streak and protect your account from drawdown, next we're going to study our last major subject, market conditions and the power of the Federal Reserve.